Good evening. I guess most of you guys are based in Southeast Asia, so time zone wise, probably is going to be the same as in Malaysia. Very quickly, I'm based in Malaysia. For those of you who have joined our previous session, I think we met briefly. For those of you who are joining in first time, my name is Yong. Now I've been trading in the market since 2012. Kind of like got into the financial market. And I had the opportunity to turn full-time in 2015. And of course, my personal experience, I've come across many different techniques, strategies, ranging from the technical perspective, looking at indicators, looking at price action, to a little bit more complicated technicals, principles like Elliott Wave. Recently, for the past 1 or 2 years, SMC has been very, very popular as well. Okay, and of course, I've also dived into fundamentals, and the whole topic of fundamentals can be quite wide. We have like macro perspective fundamentals, you have the micro perspective fundamentals, you have what we call the short-term sentiment of the market, which I kind of categorize within part of fundamentals as well. And then of course we have the seasonal trends and sort of, right? So today we'll dive a little bit more into fundamentals, but just want to very quickly give you a little bit about my background, right? Because a lot of times when people understand trading, they only look at charts, they only look at technicals. And I think that's one of the objectives of why we designed today's topic, to really give you the knowledge to support your client, not just from the chart perspective, right? But to provide something that perhaps majority of the industry don't really talk about, and this is something that you can stand out potentially as an IB. All right, because at the end of the day, you don't just open an account and service your clients like that. You want to provide them with knowledge, with support in terms of what's happening in the market in a broader perspective other than the charts itself, so that they gain that trust and connection with you. Right. So today's conversation will be very much into fundamentals. We'll look into the fundamentals not only in the currency market, but also talk a little bit about the equity side of things. And after today's session, hopefully you walk away with a better understanding of what fundamental is, what is the role of fundamental analysis in the financial market, and how you can potentially complement that with whatever technical strategies that you probably already have, right? So as we progress, you might have questions. We have designed the Q&A to be at the very end, but I always suggest, audience to just post up your questions as it pops up, right? Because sometimes if you wait until the Q&A segment, you might forget what you want to ask. I may not address your questions immediately, but when you put up your questions, at least it's on track. We can reference back at the Q&A segment. Okay, so don't be shy, just put it up, right? And of course, feel free to keep the chat coming, so that you are engaged. The more you engage, the more you take away, the more attentive you are, the more present you are in this session, the more you're going to benefit from it. Okay. So today's agenda, as I mentioned very, very briefly at the start, it's really for you to understand the importance of fundamentals, right? My perspective as a trader and as an educator, to share with traders is always, the more you know, the better you are in making an informed decision, right? A lot of times traders would say, oh, but I don't use fundamentals in my trading. I don't need to bother about fundamentals because I'm like a short-term trader. That is very myopic in a way where maybe you don't know it, or maybe you're lazy to learn and therefore you say that it's not important. But my take is always, the more you know, the better it is in making that decision on whether is it going to be helpful for you, right? Yes, short-term trading, if you're scalping the market, you might not use fundamental, but the understanding of fundamental will give you that confidence in the market, right? You at least know what's happening from a fundamental perspective, okay? So that's my take, right? Today, if you have more options, you know more things, you are in the position to make a choice. But if today you have no understanding about fundamental, then you don't even have the choice to choose whether you want to use it or not, right? So that's where one of the objectives today is to equip you with that knowledge so that you have the power to choose how you want to use fundamentals and incorporate that into your trading or even help your clients out. Right? We'll go deep into the fundamental perspective as well, right? As I mentioned, we have the macro perspective in the market, we have the FX world, we have the equities world, we have the micro aspect of fundamentals. Then we also talk about sentiment. And I think we are also very well positioned this year, actually from last year to this year, seeing and witnessing how fundamental plays a part in the financial market, right? Gold has hit all-time high this year. Of course, it's pulling back. But if you understand the fundamental I've been sharing since last year, right? Gold perspective, if you're looking at long term, it's always going to go up, right? Not all the time, not every day, but eventually, if you stretch it long enough, it's going to go up. So where does the confidence come from? It comes from understanding fundamentals. Okay? If you look at equities indices like S&P, NASDAQ, right? Long-term perspective, where do you think that's going to go? Up, right? Because again, understanding fundamentals give you that confidence. Now, not all asset class is going to do that, right? If you look at Euro USD, right? You look at FX market, then we cannot say that long term is going to go up or down, right? It's not really kind of like having the high 90% probability as compared to maybe gold and the equities market. So again, fundamentals play a part, maybe subconsciously when you're trading, right? But that's where it comes in. Okay, we'll talk a little bit about the recent case studies as well. Okay, and of course, if you have questions, put it up. As I mentioned, we have a Q&A segment designed at the very end. All good? Okay, so far so good, yeah? Cool. So what is fundamental analysis, right? The whole idea about it, if I want to break it into simple understanding, we actually have three main components, I would put it, right? One is actually, as you can see over here, the economic perspective. Basically, we're looking at the policies that central banks and governments are going to be doing. So obviously, if you're in the FX market, even actually in equities, you need to be aware of what the central banks are doing. Okay, so for example, if today a client asks you, right, what's the Fed doing? What's the direction of the Fed, right, or Federal Reserve, right? Fed is the short term. What's the current policy direction that the U.S. Federal Reserve is doing? At least you need to have some basic understanding explained, right? And how would that policy, how would that direction impact the financial market? Okay, so that's where the first component is, right? The big picture perspective. Then you have the what we call economic data, right? So in this part is the financial aspect, right? If you're looking at equities, it's looking into the financial report of a company. If you're looking at FX, right, then you see the country as a company itself, right? How well a country is performing, that would have an impact in what the central bank is going to do, and therefore have an impact in the currencies, right? And then of course you have the political aspect, right? Which we categorize as sometimes sentiment as well. Okay, for example, if you're following Donald Trump, he has been swinging the market quite a bit with his tariff policies, right? So that's actually very, very political. That's also very sentiment driven, because in the short term, nothing really has changed in terms of the performance of the economic perspective. It's just speculation, right? Is that if today I'm going to increase tariff, how would the economy perform in the future, right? Then market would take note of that and instantly react, right? So that's what we call sentiment, short-term perspective. Right. Now, obviously, today as a trader, we are not financial kind of like report analysts, right? You don't need to dive very deep into studying all the data, all the numbers. But the bare minimum as a trader or someone who's going to be guiding traders, right, as an IB, you want to have the understanding of big picture. Okay, so today if you talk about the Fed, right, you need to at least know the direction of Fed, right? Is it increasing rates? Is it cutting rates? How would that impact the market, right? So if you can guide your customers, right, your clients, your traders, with this kind of knowledge, it starts to build that connection, right? They will see it as, okay, you're not just a typical IB, but you are also providing information for me to help me and assist me in trading, right? So that's where you can stand on. Okay, so fundamentals matter, right? As I mentioned, you might not use it to trade, but today, if you understand fundamentals, number one, during a certain period of time, it can help you to avoid high-risk asset. Okay, Now, what I mean by that is that, for example, if today we go into a massive tariff war, trade war, right? I mean, trade war has always been there, but Donald Trump kind of escalated that with China, right? Now, if that really kicks in, right? So what is something that you can advise clients to maybe be cautious, stay away, right? Is maybe don't touch the Chinese yuan, right? Maybe some of the clients like to trade the Chinese yuan as an exotic pair, right? You might want to stay away on that, right? Maybe if today we talk about not just that, but we talk about, let's say, the Bank of Japan, right? If today Bank of Japan decides to make an intervention, which is something that they've done, what do you need to do? You need to then understand, all right, with that Bank of Japan coming in as an intervention, volatility on the yen pairs are going to increase drastically. It can go up overnight, come down overnight. What do? You want to then stay away from trading maybe the yen pairs in the short period of time until things kind of settle down, right? So understanding this again can help you to avoid certain unnecessary trade, which might result in unnecessary losses as well because of the volatility. When things like this happen, again, it's very hard to kind of trade because things can move very fast. It can flip overnight. Okay. If you've been in the market for some time, you might also experience or witness some of the black swan event. For example, the most recent 2022 Swiss franc crisis. If I recall is correct, right? Swiss franc crisis. So what happened on that is not 2022, sorry, way back. Okay, what happened on Swiss franc crisis is that previously, okay, just a backdrop on that. Previously, they have agreed on the floor, right, to kind of support the currency at a certain price point, right? So whenever the price drops below that, they'll push it back up. And then until some point, the central bank says enough is enough. I'm not going to do it anymore. The market on dollar franc crashed. Okay. So is that a technical perspective? No, right? Because technical traders will say, oh, that's a very strong support. The market will be bouncing off there. But if you understand fundamental, you can see that incoming. You would then avoid touching the dollar franc because during that period, it's going to be very volatile. Okay, so things like this is something you need to be aware from a fundamental perspective. Then you know how to make that decision. Okay, so that's where it leads to the second part that you see on the slide, making better investment decision, right? So obviously, these are some examples that I talk about in terms of the FX currency war. Now, how would this be applied if let's say you are in the investment equities perspective, right? Same thing, okay? If today we talk about central bank first, right? The policies would have an impact in the equities market. Now, obviously in the financial market, nothing is going to be 100% all the time. But if today you understand, all right, if the macro environment in the market is liquid, right? So what does it mean? It means that generally central banks are loosening. They're reducing interest rate. They're doing quantitative easing. They're increasing the money supply into the market. So this is actually what we call loosening. QE in short, right? Liquidity is increasing in the entire market itself. Generally, this kind of environment supports a bullish equities market, right? So when you start to observe, right, the Fed is cutting rate, the Fed is printing more money, they're introducing liquidity into the market. What would you do? Okay, you can look into maybe general indices in the US equities, look to buy opportunities. Okay, if you dive deeper into that, which we'll talk about in the second segment, right, you can look into sector rotation. Okay, different cycle of the economy would have different impact in different sector, right? So you have the energy sector, for example, right? You have the what we call consumer discretionary, right? You have the technology sector, you have the finance sector, right? Which phases of economy we are in would have a different impact of this sector. Okay, so as someone who understands fundamental, you can prepare your portfolio by rotating out from certain sector and then maybe invest more in certain sector during those phases. Okay, key case studies, right? COVID. Okay, not too far back, everyone was very worried about the whole world economy, right? Equities, stock market did drop pretty drastically, right? But if you look back at COVID years, the recovery in the equities market in general has been very, very strong, right? Meaning the drop is fast, but the recovery is fast. What actually contributed to that, or what gave confidence if you actually understand fundamental to take advantage of that, is actually understanding liquidity again, right? What happened during COVID is that all central banks globally just decide to cut rate very aggressively. Okay, so again, when they cut rates, when they do QE, they introduce money into the market, liquidity increase, it's generally good for equities. Right? So again, all these things, again, from fundamental, give you that confidence, right? It may not necessarily tell you exactly what price to get in, when to get in. That's the role of technical, but the fundamentals give you the big picture. Okay, so again, it can give you the long-term trends, and of course, you can combining with technical, it can help you to assess things more accurately, right? From the direction perspective, fundamental is the one to go. Okay, so far I can follow, yeah. So this is where I kind of talk a little bit about in the previous slide, right? Understanding market cycles, understanding economic cycles. There are generally 4 phases in the economy, right? We have the expansion, we have the peak, we have the recession, and then we recovery. Generally, I would put it that it's going to be from one cycle to another, right? Obviously, it's not so straightforward, but you can always look at it from the perspective the economy is going to expand, it's going to reach a peak, it's going to hit recession. After recession, it's going to recover, and then it's going to go into expansion, and it repeats itself in the cycle. Okay, where do you think we are right now? Okay, I mean, COVID is obviously a recession, right? The whole market went into it. The recovery was fast. We went into expansion. We're probably within the peak period right now, right? How can you relate this to what the central banks are doing? Very straightforward, right? If you follow the Fed is also having a policy cycle. What do I mean? It's going to increase rates, it's going to hit the peak, it's going to start cutting rates, then eventually it's going to start increasing rates again. Okay, the financial system has been designed in this cycle some time back. Okay, so you have this cycle of inflation, recession, rate hike, rate cut, and when you study this pattern, you can then relate how is this going to impact the market. Okay, so today if you look at the Fed, right, not too long back, just last year, the Fed has been increasing rates pretty aggressively, right? Because the fear of inflation kicking in, and then they start increasing rates. The logic behind it is today, if I increase rates, things are generally going to be more expensive, right? Today, if you take a loan, your interest is higher. Today, you want to expand businesses, you need to take a loan, your cost is higher, right? So think of inflation and rate hike as, cost of money going up. Okay, if today a cost of money is going up, you tend to spend more prudently. You don't anyhow expand your businesses, right? You're gonna think twice. Now, when you do that, generally the market, what they'll do is they'll reduce in their spending, right? The market will spend less. It will cool off the economy a little bit. Okay, demand will drop. Okay, and then you will reach a certain cycle where people now don't spend as much. Then there's the fear of the opposite. If people don't spend that much, demand is not there, then if the economy is not doing well, then it will fear of going into recession. Then what the Federal Reserve will do, they'll do the opposite. They'll start cutting rates, right? When they cut rates, they'll encourage spending. That's why there's this cycle. Okay, so from a FX perspective, if today the Fed increase rates, generally the US dollar will perform well. Okay, if you look at other central banks like the Bank of England, Bank of Japan, Bank of Canada, more or less the same principle applies, right? If a bank raises rates, the valuation of the currency will go up. If the bank cut rates, the valuation of the particular currency will go down. Okay, the understanding behind this kind of relationship is that put yourself in the perspective of an investor. Okay, today, if there's a higher interest rate available, let's say in the US, right? As an investor, I would want to put my money there because I can collect a higher interest. Today, if I want to put my money, for example, in the US because I want to collect higher interest, what do I need to do? I need to convert my currency into the dollar, right? By doing that, naturally the demand for the dollar increases. Okay, demand for the particular currency increases, the valuation increases. Okay, so That's the logical understanding. Okay, now of course it doesn't mean that the Fed cut rates and therefore the currency will definitely come down or immediately come down. No, right? This again provides you a overarching perspective. Okay, so for example, put things into practical perspective. Moving forward, the Fed are looking at easing policy, right? Because we're at the peak. They start to plan, okay, when are we going to cut rates, right? Rates are likely going to come down. How aggressive is coming down, we don't know. But very highly likely, the Fed is going to not increase rates and potentially looking at cutting. So when that happens, right, what would generally happen to the dollar? We'll see a devaluation of the dollar. Okay. Now, if today you look at currencies, of course, they're in pairs. You want to then compare what is the other central bank doing. Okay. Now, if you pair it with gold as a precious metal itself, it has its inherent demand. If the dollar is going to weaken, dollar gold, that particular instrument is likely going to go higher. Okay, so again, fundamental plays a part. Without looking at the chart, you generally can know long term, mid to long term, where the direction focus is going to be. Okay, so far so good, can follow through, yeah? So, speaking about all these things, right? Where can you prepare yourself, right? How can you understand what's upcoming? Look into some of the economic reports and things like that. Number one, of course, central bank releases, right? I mean, I've talked a lot about the Fed, right? But I want you to understand that in the currency world, it's not just the Fed, right? You have the Bank of England, you have the Bank of Canada. Generally, every country would have a central bank. So if you're looking at the top 7 currencies, you have like 7 to 8 central banks you need to be aware of. Okay. Now, typically, every central bank tends to follow the direction of the Fed. The reason is because the dollar is still one of the global leading currencies. Everyone seems to be following it. Okay, meaning if the Fed decides to cut rate, generally, majority of the countries would also look to cut rates. Okay, so you want to look into this. Typically, a central bank is going to release its kind of report about 1 month to 1.5 months, right? Some countries is once a month, some countries is about like 5 to 6 weeks, okay? So you want to read into those reports, understand the overarching direction. Are they increasing rates? Are they dropping rates? What are their concerns over the economy? Okay, you want to take note of that. Of course, today we won't have the time to go into very, very detailed stuff, right? Again, if you want to break down a kind of like central bank statement, it's not that difficult, right? A lot of times I would hear traders say, oh, but I don't study economics. You don't need to study economics. You just need to understand simple terms. Then you can actually understand where the direction is, right? Again, we are not using the report to make trading decisions. We're just using the report to give ourselves the big picture perspective so that when we make decisions in trading, we have that confidence. Okay. Now, another part you can take note of is economic calendar, right? So this one is a good practice to look at it on a week-to-week basis, because most of the events, to be honest, in terms of like economic data are pre-planned, right? Which means you already know like next week what events are coming out, right? You already know like next month what events are coming out. Okay, so these are what we call pre-planned events, right? So what are these? They are like your CPI data, or your NFP data, or your unemployment rate data. Okay, these are important data to track as well, because this data is like, think of it, your report card. Okay, if your economy is doing well, this data will be doing well, and therefore that would preempt what the bank would likely do. So traders are starting to take action because of that, right? So you want to be aware of like what's upcoming, right? So for example, the very first Friday of the month, some of you already know, you have the NFP, right? Non-farm payroll. That's a very important piece of data. It's going to create volatility. While that is, a small part of fundamental, it's not the entire thing, right? A lot of times traders will also misunderstood and say that, oh, NFP data is good, and then therefore you buy into the particular currency like dollar. That's a little bit misleading, because think of it as NFP is one data. Yes, it's a big data. but it's just one data. If today in the economy only NFP is doing well and then the rest are not doing well, okay, it's still not doing well. Okay, so I want you to understand one single piece of economic data doesn't equate to fundamental analysis, right? It's part of it, but it's not the entire thing. Now, speaking of pre-planned, there are also events that are unplanned. Okay, now I give you case in point, the Bank of Japan. Okay, Bank of Japan, their events are often unplanned, right? Or even if they plan it, it's always in the economic calendar, you would see the word tentative. Like, you don't know the exact time until it happens. Okay, so things like that you want to take note. For example, Bank of Japan conferences, Bank of Japan reports and announcements, they're always tentative. Okay, which means it's very hard for you to understand, is it going to happen in the morning, is it going to happen in the afternoon? So what you tend to do is, you can suggest to your clients and say that, okay, today you have this high impact news in the yen, maybe be cautious on number 2, or you can stay away, right? So you can use all this to actually provide additional support to your clients as an IB, right? You can tell them, just give them a reminder, this week you have this news, take note of, right? Today you have this news, take note of. Volatility might increase. Okay, so again, you need to know all this. You need to have the basic understanding of all this. Then you can actually support your client better. Okay. The other type of unplanned events are sudden surprises, right? So I mean, this year so far we didn't really see much of it. But typically on an average year, you get sometimes, market sudden uncertainty, right? So I recall there was one year, there was a missile fired, okay, unplanned, and the missile was traveling, and then the market was shaking, and then it landed into the ocean, and then the market decided to calm down. Okay, that was where you can observe gold. When the missile was fired, the gold price shot up as well, right? When the missile landed in the ocean, gold price came back to where it started. Okay, so obviously that's unplanned, right? Because nobody knows until it happens. So things like that, to be honest, is a little bit more difficult to prepare and preempt. But that's where risk management comes in, right? So you need to also guide and share with your potential clients, right? Tell them that things like that happened before, and if today you don't have a proper lot size, you don't have a proper position size, and when things like this happen, you can get stop out, you can get margin call very easily if you kind of like take too big a position in your account, right? So all this, again, things like this you can actually share with a client to give them that confidence in trading. Okay, so far so good. Everyone's following, right? So yeah, I went and talked about risk management, right? Cool. So fundamentals, you can realize that its role is not to help you make the decision on what price to enter, what price to get out. It's not giving you the entry, it's not giving you that stop loss or take profit, right? But but fundamental plays a part in giving you the broad picture direction. It plays a part in maybe giving you that confluence factor that you need, right? The confidence in executing a trade. It also gives you the perspective of how you're going to manage risk, right? So we talk about certain events happening, how you can avoid it, because of increased volatility, the importance of risk management in the perspective of fundamentals of how things can, suddenly happen and then impact the volatility of the market. Fundamentals, while it's not entirely under the fundamental, I would tie in market correlation as part of it, right? Because you need to understand how the different assets have react to each other, the correlation with each other, to help you in the risk management, right? So again, this is something of like fundamental perspective also, right? So what I mean by that is today, if you're trading currencies, right, I think you would be aware the euro dollar and the pound dollar has some kind of a positive relationship. The euro dollar and the dollar franc would have a negative inverse relationship, right? Gold and silver would have quite similar relationship. Canadian and the crude oil would have a positive relationship as well, right? What I mean by positive relationship is that if one asset increase, likely the other will go up. Inverse relationship is the opposite, right? So this understanding is also very important in the risk management perspective, because if today you're going to have a position on euro dollar, let's say you want to buy into euro dollar, right? And then you go and analyze, oh, dollar franc, okay, dollar franc can sell, right? Most of the time you're going to get that because they are inverse, one buy, one sell, right? In the price chart, typically, if you have a buy setup on euro dollar, there's a very good chance you get a sell setup in the dollar franc. But today, if you take both position with your average similar lot size, then you're essentially taking 2 times the risk. Okay, why I say that? Because they are inversely correlated, which means if you buy one and you sell the other, if the market go against your position, you're gonna likely lose both concurrently. Okay, so you need to understand this as well, right? I call this market correlation, or I use the term risk exposure, right? Which means you need to assess your risk management perspective from also understanding beyond the charts. Okay, if today I buy this and sell this asset, are they correlated? What's their relationship? Am I over risking? Okay, beyond currencies world, you can also look into correlation in terms of equities. Okay, so for example, if you look at Tesla, right? Tesla is a automaker, meaning they're related into the car industry, but at the same time, Tesla is also a technology company. Okay, so if today you look at that and then you compare it with another company that deals quite similarly in the tech sector, then they are correlated, right? For example, if you look at Apple versus Nvidia, now it's not exactly in the same industry, but both are tech, both have certain relationship. Okay, if you look at indices, S&P and the Nasdaq, generally they're the same. Okay, so things like that you want to understand and educate your clients as well. Okay, so that again they might not be aware, but when you tell them that information, that suddenly they get that, oh yeah, I never think about it. You start to build that trust with them. Okay, so risk management perspective, very important. Okay, so again, all this is kind of like, you can look at it as complementing your trading plan, your strategy itself. Okay, now to be very honest, I've never seen a trader purely use fundamental to trade. Okay, you can be an investor and based on fundamental, no doubt about that, right? But if today you are trading, unlikely you're just purely using fundamentals, right? Now let me clarify what is investor, what is trader, right? Because some of you might not be very familiar with the term. The definition of a trader is more of like a short to mid term, meaning you're looking to get in and get out, and you're looking to just basically take advantage of price movement, right? It doesn't matter whether the price goes up, it doesn't matter if the price comes down, you're basically just looking to benefit from the movement of price, right? The objective of an investor is slightly different, because as an investor, you're looking at really prioritizing the fundamentals. You're looking at investing into an asset that fundamentally would grow, right? And as the value of that asset grows, so does price. Okay, and generally you only be looking at buying it if you're an investor, right? As an investor, you don't really look to sell, right? If you're short selling, you're basically trading a price. Okay, so understand that perspective as well, because the fundamental would come in to support very differently, right? As a trader itself, the fundamentals knowledge, as we've covered so far, help you primarily to mitigate risks and give you that confidence, right? It doesn't really help you to say buy now, sell now, no, right? But as an investor, fundamentals play a part, as I've covered, but more towards also telling you whether to buy or not to buy, right? Because if the fundamental of a company is strong, it's a buy call, right? If the fundamentals of the company is weak, you don't want to be buying into that company. Okay, so also understand from that, right? And of course, as you dive deeper into it, at the very start I mentioned, right? Seasonal analysis is part of fundamentals, right? Understanding the seasonal trend. During the year-to-year period, which month does this asset tend to rally? I'm going to give you one example, which a lot of traders are interested in this asset, right? Gold. Okay. So typically, gold seasonal trend is that from November, end of year, to around next year, February, gold seasons are usually bullish. Okay. April is where gold tends to actually come down, right? Which is what you actually observe right now. We're in the April month, gold prices are retracing. Okay. Now it's not 100% all the time, but what does seasonal data provides you is that it gives you a direction to start off with. So you know, okay, if gold seasonal trends from November to February is likely bullish, you're going to focus on buy trade. Okay. In April to maybe June, gold trends are generally flat to bearish, right? So what you do, maybe you can look to exit some of your buy position, you can look to maybe trade a pullback, right? Or at least maybe be a little bit more cautious in buying, right? So seasonal data provides you that information, that insights that technical charts may not provide necessarily, okay? For those of you not familiar with seasonal trends, what it does is basically studying for the past maybe 5 years to 10 years. Okay, so if now it's like 2025, you look back all the way until 2015, every year, January, how did the price of an asset perform? Okay, so if let's say past 10 years, every January, that asset goes up. This tells you that statistically, January is a bullish seasonal month, right? Because out of 10 years, all January goes up. Then maybe you look into February, right? Out of 10 years, February, maybe 8 went up, 2 came down. So it has what? It has an 80% statistics stating that February likely price will go up because it went up more times than it come down in February. Now, if today you look into March and then you realize, oh, March, 6 times it went up, 4 times it comes down, right? Then that's not a very high stats, right? It's almost 50-50, okay? So when we look into seasonal data, from a fundamental point of view, we're looking at seasonal trends. You want something more than 70%, right? Then that gives you slightly more confident, right? If you're a little bit more selective, then you go for 80% and beyond, right? So again, what does this do from the big picture perspective? It gives you some insights. It gives you data instead of just doing guesswork. Okay, so things like that, you know, it's beyond the chart, right? If someone only look at price action, only look at indicators, they will not have this understanding, they will not have this insights, right? So hopefully up to this point, you guys can really see why fundamental is important. How does this extra piece of knowledge and information can really help you, to stand out as an IB, to kind of support your clients a little bit better, because people out there may not actually have this to support their client, right? They only gonna look at, oh, MA crosses is a buy signal, right? You can go beyond from there. So far so good, everyone's following, yeah? Good. So yeah, I've been talking all this. The real objective over here is to really equip yourself with the extra knowledge, the extra insights, right? To stand out, right? And with that, hopefully, you can upgrade yourself as an IB, not just a typical IB, but IB with certain knowledge about the financial market, about trading, to support your clients a little bit better. Okay. So far so good. If I don't see any questions so far, okay, but as I mentioned, if you guys have any questions, put it in first. We will do it in the Q. We'll answer your questions in the Q&A, but I don't want you to kind of like after that, forget what question to ask. Right? So with that, I think we'll go for a very quick break. I'll pass the time very quickly back to Joshua first, to kind of like do a quick wrap up of the first part, to go for a break, and then we'll come back later as well. Okay, I'll pass the time back to Joshua. Good. So I hope so far you guys are able to follow through. Okay, especially for those of you who are first time coming across the topic and the conversation about fundamentals. Hopefully you at least take away something. As I mentioned at the very start, if you have any questions, feel free to put it into the comments first, so that you don't forget the questions that you want to ask. Obviously, you can ask more than one questions, so you don't need to be afraid that you post something and therefore you can't ask another question. Yeah, so the first part of today's session, we really dive more into the bigger and broader perspective of fundamentals. Okay. This second part here, I would dive a little bit more into the kind of like details of the analysis itself. Okay. And fundamentals, basically, we're going to break it into generally two assets, the currency asset classes, and then of course you have the commodities like gold and things like that. I'll put that under the currency world, and then you have the general asset, which is the equities market. Okay. So why we want to break this into, not break them, but really more of like categorizing them into two parts. It's really because if you're more into the currency market, right, you look at fundamental from a macro perspective. If you're more into the equities, mainly kind of like selecting individual stocks, you are actually more into the micro perspective of the fundamental, right? Of course, the broad picture perspective also does impact. But if you're more of like stock picking, you definitely want to look into more in the micro perspective. Okay. So today's introduction to fundamental analysis on the second part here, it's where we're going to talk a little bit more into the macro perspective, which is the currency, precious metal point of view. And then we'll also talk a little bit about the micro perspective, right? For those of you who are maybe guiding clients and sharing about, stock picking, okay, individual stocks and things like that. Okay. So let's talk about the macro first, right? I think in the first part of the session, we did talk about interest rate, right? We did talk about how central banks' decision can impact the financial market. Okay. This part here, you can see on the slide, we have three components, right? We have the economic growth, which is basically your economic data. Think of it as I mentioned just now, a report card, right? So a country would have different aspects based on the economic indicator. So name some is like you have your CPI data, you have your unemployment rate data, you have your labor market, which in the US is the NFP. You have inflation related to your retail sales, GDP and things like that, right? So what that does, okay, it's really to give you an idea of where the overall economy is performing, right? Is it generally good? Is it generally not good? Why is it important? Because that would then lead you to understand what would the banks likely gonna do, right? Are they gonna be cutting rates if the economy is not doing well, or if the economy is doing too well? They need to start considering increasing rates. Okay, and then of course that would also tie into some government policies, right? Like for example, Donald Trump policies itself is what we call a protectionism, right? Where it tries to bring all businesses back locally, and therefore it increases the tariffs, right? And that is part of government policies. So they are kind of interlinked, right? But as a trader, generally you just want to be focusing more on the economic performance as well as the central bank, right? If you're more into stock investing, government policies are going to be very important to you, because you need to understand which sector, which industry tends to perform better based on certain policies that the government actually roll out. Okay, so this is where things starts to differ a little bit depending on which niche you're going to be, right? Are you more into FX? Are you more into equities? Okay, so that's the macro perspective. Okay, the micro view in terms of currency market is not too significant, because again, currencies, we are looking at countries, which is already the global scale, right? The micro view is where, if you look into stock picking, okay, you want to study again sector and industry. So this is where you need to understand, okay, in a stock market itself, right? You have like various industry, like some very common ones are including technology, healthcare, consumer discretionary, then you have the oil and gas energy sector, things like that, right? Some sectors are more resilient in terms of fluctuations of the economy. Some sectors are more sensitive, right? Like tech sector itself is pretty sensitive to interest rate. So how do you understand all this, right? Obviously, some understanding about economics, some understanding about how the sector performs, what is the sector about, does help. Okay, but the logic behind is basically, think of this, right? Technology sector, a lot of the companies are what we call fast-growing company, right? They are startup based, right? They're moving very, very fast. Generally, they are more sensitive to interest rate simply because a lot of these startups are new. They're expanding their business aggressively in the tech sector. They are actually borrowing money from the bank, right? So if interest rates goes up, then it will directly have a major impact in their earnings, right? Costing goes up, profit comes down, right? So they are more sensitive to that, right? And then if you look at maybe healthcare industry, they are less sensitive to the fluctuation of what the economy is doing, because it doesn't matter good or bad economy, you need healthcare, right? But that also means that that particular industry is not going to give you that massive boom, right? It's not going to give you that massive return that technology sector can provide, okay? So there are pros and cons, right? So this is the part where if you go into equities market, it's a whole aspect of, information and knowledge, which differ from currency market, okay? So for those of you who have yet to, even step into investing, haven't stepped into understanding companies from the financial point of view, hopefully then again, this will give you that first introduction, okay? So this is the part where you want to go into the financial reports of companies, right? Understand the different metrics, the different financial ratios, how well this company is performing, is it worth investing into it, okay? This is the part where I want you to be aware also. Looking at the fundamentals of an individual company, you need to kind of pull the prices of that stock separately when you're analyzing the fundamental, okay? A strong, solid fundamental company can have massive dip in prices as well, right? Why? Because fundamentals don't drive prices in the near term. Sentiment move price, but fundamentals gives you that base intrinsic value, right? For example, if today you know that, okay, I'll give you some example. If today you know, okay, this item is a necessity, right? And then suddenly it drops below the production cost, right? What will happen is that everyone will start buying because it's cheap, right? Intrinsically, the value is there, but the price is cheap. People will then buy because it's seen as a discount, right? So if you look at stock market, it's kind of have that analogy as well, right? Have that in mind. Fundamentals of the company doesn't necessarily translate to the price of a stock during the near term, okay? Because there are many factors can affect the price, but as an investor, if you're looking at the fundamentals, you need to separate the price with the fundamentals, okay? So just very basic introduction about some of the financial ratios over here, the common ones, right? So there are definitely more than that, but the common ones here we have EPS, right? Earnings per share. As the name suggests, right? It's basically just looking at the total earnings. Earnings is basically the profits from market, divided by the share available in the market, right? So a company itself would release share to the market, okay? And basically that's like quote unquote supply, okay? So if today the company is making a lot of money and there's a fixed amount of share in the market itself, then your EPS will actually goes up, right? So higher EPS means that this stock, the value of it is going up, right? The fundamental of it is strong because the supply is lower relative to the profits that the company is making. Okay, so think of it. But obviously, it's not just, oh, you look into high EPS and then you just buy the stocks that high earnings per share, right? Not necessary, because earnings here fluctuates, right? And this is only one of the many metrics. Okay. Then you have price to earnings ratio, right? PR. This is where it's a little bit more sensitive to the current market price, because if this is a good metric to understand, okay, based on company's profit and the stock price, okay, how do they balance off, right? So if earnings increase but price of this stock is still maintaining, what does this do? This ratio would be going down. Okay, meaning is what? It's cheap relative to the company's profit, right? If price to earning ratio is very high, meaning that this stock is quote unquote expensive, right? Because people are overpaying compared to the profits that this company is doing. But again, as I explain some of this, right, I just want you to be aware, it's not a kind of like simple, oh, if PER is low, you buy, right? It's not. It's just one of the many metrics, right? So you might need to then eventually go deeper and build out what we call a valuation calculator, right? So you can understand based on the different metrics, okay, is this stock overall worth investing, right? Is this stock intrinsic price overall there, right? So today, again, I don't want to overcomplicate the whole process. It's really merely to kind of introduce you to this. So you have a basic understanding. If you're very into it, you're very interested into it, go deeper, okay? But at least with a basic understanding, you can actually share and guide your potential client, okay? So price to earning is looking at that, right? And then we have the return of our equity, ROE. This is very, very simply, based on the company's equity, what's the percentage that they are making. Okay, obviously, the higher the ROE, the better it is. Some industry will have certain benchmark, right? For example, if the ROE is above 15, it's good. If the ROE is about 20% and more, it's a very solid company, right? So based on this metric, you can give yourself some gauge on that. Okay. Then another very important kind of ratio is the debt to equity. As the name suggests, is basically comparing companies' debt to the equity that it has, right? Equity is more like an asset. Okay, so obviously this one, the higher it is, the less safe the company is, right? Because if the debt is very high, the equity is low, then there's a possibility where the company may go bankrupt, right? Because it can't sustain the debt, right? It can't repay the debt, and then the company goes bankrupt. In theory, if the debt is zero and then there's equity, then I mean this ratio is literally zero. In theory, it's like the best, right? Because it means that this company has no debt, it will not technically go bankrupt, right? But then you need to also understand and put that into perspective of the industry, okay? Because in the US, a lot of companies are always expanding, right? And today, if you don't have a debt, meaning you're not kind of like leveraging on quote unquote other people's money to grow your business as well, right? So depending on the on which country you're in, right? So if you're looking at, like, let's say Malaysia and Singapore company, again, geographically, we can't really expand very aggressively locally in Malaysia and Singapore, right? Unless the company chooses to go overseas, okay? So that factor alone would have a direct understanding, or I would say direct impact on how you understand this ratio, okay? Today, if you're looking at companies that are locally in Malaysia or Singapore, okay, I see some of you are from Indonesia and Thailand, I think it's the same thing. A zero debt company, we will classify that as a very solid company, okay? Because it means that this company has zero debt. It's very unlikely it's going to go bankrupt, right? But if you're looking at companies in the US, right, you will very hardly find a company with zero debt, because all companies are essentially borrowing money to expand, okay? So some of these ratios, you want to be putting some layer of context, right? If you're looking at local stocks, you might need to tweak some of this understanding in terms of like which one's better, in terms of, let's say, for example, performance of ROE, right? Today in Malaysia and Singapore, if you can find a company with 15% ROE, it's solid. Okay, in the US, you can easily find company with 20% and above. Okay, so put context into your analysis based on the geographical location as well. So far, I can follow, right? Now there are more kind of like financial ratios that you want to look into, right? So I'm actually looking at some of my previous works that I've done. I don't really go into the metrics every day because the fundamentals of company don't shift overnight. They don't change overnight, right? Typically, you want to look at it, at most quarterly, if not yearly. Okay, quarterly means every 3 months you look into it. If not, then you look at it every year because that's where the financial year report comes in. Okay, so there are more things like what's your net profit margin, what's the cash flow, change in cash of the company. You want to understand all this. Does the company pay out dividend? Right? If you're doing dividend investing, then of course that metric is very important. What's the payout ratio? What's the dividend growth? All these things are important, right? So we talk about ROE, then you also have the return of asset, return of investment, ROA, ROI. All those metrics are important too. Okay, so again, I don't want to dive into too complex stuff, but I really just want to give you guys an understanding of what it is, right? What are some of the things that you need to take note of? Okay, so we talk about dividend, right? Why I put this here is because it's often a misunderstood kind of matrix, or often kind of dividend investor put too much priority on this. Okay, so what is dividend yield? Okay, let me explain first so that you understand. Now, dividend yield is basically taking the company's dividend payout over the price of the particular stock. Okay, so for example, if today the company pays $10 as dividend on a yearly basis, and the stock price right now is $100. Okay, meaning in order for you to get the dividend of $10, you need to buy a stock, and to buy a stock, the stock price is 100. Okay, so if you take this understanding, this simple math, then the dividend is 10, the price is 100, your yield is 10%. Okay, meaning you use $100 to buy the stock. In return, you get $10 as dividend. Okay, on an annual basis, so that becomes a dividend yield of 10%, right? So in percentage wise, right, a lot of times dividend investors will think, oh, the higher the percentage, which means the higher the dividend yield, the better a dividend stock is, because then you can get back more. Not necessarily true, right? This is where I want to bring this up, because if you talk to clients that really talk about dividend investing and then they keep emphasizing on dividend yield, then it's an opportunity for you to share with them more so that they understand a bigger picture. Now, today you're going to look into dividend companies, right? Meaning you're a dividend investor, your primary goal is to invest in companies and then collect dividend. Yield is important, yes, but based on the formula of dividend yield, right, you're actually calculating based on the price of the stock. And understand this, price of stock are volatile. They can fluctuate pretty quickly in the short term. Okay, so today if the market crash, obviously your dividend yield will go up, right? Because stock of that particular price is coming down. But does it necessarily mean it's a good company? No, right? If during normal circumstances this company price keeps coming down, what do you think the yield will be? The yield will be going up. But doesn't necessarily mean it's a good company to be investing in, because there might be real reason or real trouble why the stock price is coming down, right? Maybe the company is really not performing anymore, people are selling the stock, and therefore the price is coming down, and then you, looking at the yield only, you thought that it's a good company. Okay, so I just want you to be aware that dividend yield itself is not a very solid metric for a dividend investor, to be honest. What's a better ratio to look at dividend is to, number one, look at dividend growth. Okay, now what is the dividend growth? Meaning on a year-to-year basis, did this company increase its dividend payout? Right, obviously the more consistent the company increase its dividend, the better it is. Okay, because what you want to do is today you want to invest in a company that pays you a dividend, let's say for example 5% today, but next year it's going to increase by maybe 5.5%. Then next year maybe 5.8%, then the following year 6%, right? You want to invest in companies that constantly increase its dividend. Okay. Another matrix that you want to understand for dividend investor is a payout ratio. Okay, so the payout ratio matrix is basically understanding how much of a profit did the company use to pay dividend. So you want a balance, right? You want a good balance. If today the company used all its profit to pay out as dividend, then the company has nothing left to expand. The company can't really grow. So you need a balance. Okay, a good ratio is below 60%. Okay, a good ratio is below 60%. Of course, this again depending on the industry you are in. Okay. Lastly, okay, is really then look into the dividend yield, right? Dividend yield, because it's related to price. If today there's a market crash, in general market panic, but the company is still a very good company, your yield will go up. Okay, so that's the idea behind it, right? So hopefully again give you some insights into all these things. Right, so let's move a little bit into the FX market, right? Because not everyone is into stocks, but hopefully giving you an insights into equities market, give you a better understanding. You know, if your client is interested in stock market, there's some conversation you can talk to them. Now, Forex, okay, FX world. Again, how do you understand FX in the relation of a company? The country itself is the company, right? If you're talking about currencies, the country itself is the company. So then the micro perspective of it is really studying how well the country is performing, right? It's just like studying how well a company is performing. This one, you study how well a country is doing, right? So some economic data that are important, I generally categorize into two. One is the inflationary data. Okay, the other category is labor market, right? So things that deal with unemployment rate, things that deal with wages, they're all labor market. And then the other part is inflationary. Your CPI, your PPI, your GDP, okay, your retail sales, those are inflationary. Okay. Why categorizing these two parts is because every central bank has primarily two objectives. One is to achieve full employment. Number two is to ensure economic price stability. Right. So full employment doesn't mean that everyone is employed, but basically just means that everyone who wants to find a job can find a job, right? So full employment is their objective, and how do we measure that? Based on labor market data. Stability in price, basically that's also inflation, meaning you don't want prices to increase too drastically, but you want a healthy increment in that because it means your economy is growing, right? So price stability is essentially talking about inflation. Most developed countries would have an objective of achieving about 2 to 3% inflation rate per year. Okay, so that's again good data, good insights for you that you can pass on and share with your clients as well, right? So what this means is that if today the benchmark, the objective is about 2 to 3% inflation per year, and then you realize that okay, currently the country inflation is below that, then you know the central bank is likely going to do something to push this up. Okay, if your objective is about 2 to 3% and right now your inflation is about 3.5 to 4%, what do you think the bank would do? The bank would do something to bring it down. Okay, so to bring inflation up, you need to encourage the people, the economy to do spending. You need to increase demand. Just now we kind of talk about, right? Today, if you increase demand, you need to reduce the cost of money. You need to reduce interest rate. People will spend more. Okay. Today, if your inflation is above 2 to 3%, you need to bring it down. You want to reduce demand, right? How do you reduce demand? You increase rates. Okay, so you can see how simple it is once you understand the relationship and you understand what's the objective of central banks. Okay, so this would then again have an impact in the valuation of the currency, right? If today the central bank increase rates, currencies likely go up. Okay, if today the central bank cut rates, there's a good chance the currency would devalue itself. Okay, so that's the understanding of currency world, right? Very, very simple. Now, let's talk about market sentiment. Okay, so just now I also mentioned, right, at the very first part of the session, Market sentiments are very short-term thing. Okay, these are like news, speculation. These are potentially market rumors. I gave you an example when the missile was fired. Okay, that's market sentiment. Okay, that causes uncertainty in the market. Okay, so there's one part in the financial market that we really can't fully prepare, and that's sentiment. Okay, because it comes as a surprise often, and things like this is very hard to prepare. Okay, but it's good to understand how the market will react to certain news and certain sentiment. Okay, so this is where we have the term risk on, risk off. Okay, think of it as a switch. If today we are in a risk on environment, meaning we turn on the risk. Okay, so in a risk on environment, traders and investors are likely to take a higher risk. They are willing to take a higher risk. So that's called risk on. We turn on the risk. Okay. The opposite of it is called risk off, which means today I'm not willing to take high risk, right? I switch it off. So when are we in a risk on and when are we in a risk off? How do we know which phase we're in? There is no single metric to give you an answer, but generally, if there's nothing uncertain, meaning everything is calm, it's great, it's good, we are in a risk on, right? Because things are calm, traders and investors are willing to take a higher risk. When things are uncertain, if you think of things like Donald Trump suddenly throw tariffs around, right? It shakes the market, it provides uncertainty, risk off. Okay, that's why you see gold are spiking, earlier this year. Okay, so risk on and risk off is an understanding you need to know. All right, now how does it impact the various asset classes in the financial market? Okay, now today if you're risk on, meaning you're willing to take high risk, general asset that will perform well includes your equities market. Okay, that means your S&P, Nasdaq, Dow Jones generally would be going up if we are in a risk on, right? People willing to buy into that. Okay, risk currencies, for example, Aussie dollar, New Zealand dollar, tend to perform well during a risk on environment. Okay, doesn't necessarily mean it's gonna go up. This is just again one factor among many. Now, risk off, when things are uncertain. Okay, what are the impact in the financial asset? Number one, equities would likely go down, right? So you actually see during the tariff introduction, what happened to the S&P market? It came down significantly, right? So risk off environment, equities tends to go down, right? Your Aussie and New Zealand tends to go down. What tends to go up is your number one, safe haven asset. Okay, so what is safe haven asset? Gold, precious metal. Okay, so you realize gold shot up this year, right? Number two, currency wise, is your safe haven currencies like Japanese yen, the dollar, as well as the Swiss franc. Right? Now, doesn't necessarily mean again all these currencies will go up during a risk off. It just means that likely you see some support from these currencies, right? So doesn't mean okay, I just want to be very clear because a lot of traders would then think, oh, okay, if it's a risk off, I buy yen. Not necessary. It's just again one factor. Okay, so as a trading plan, you might have like market sentiment as one of your checklists to see if it complements and confluence with whatever analysis and strategy you use, right? So you cannot use market sentiment as the only factor in decision to get in a trade. Okay, so I hope that's clear. Okay, so risk on, risk off, right? So you can see those asset classes that's going to be impacted. Okay, so you can actually see this in real time. When things are uncertain, your focus can be on gold. Your focus can be on yen. Okay, when things are pretty calm, pretty okay, your focus can be on the equities market, right? So again, based on what's happening currently in the market sentiment, your focus can shift. Okay, so again, these are things that you can prepare yourself as well as the client so that there will not be like panic, right? What's happening in the market right now? Why this prices suddenly start moving while there's no news, right? It can be because of market sentiment. Okay. Some other things that might impact the fundamentals, right? I think this one, all of us experience it this year. Geopolitical and politics, right? So things like elections, things like trade war, may impact the entire market, right? Not only the currencies, but also equities that have relation to this. Okay. But bear in mind that geopolitics and political stability sometimes can be short term, sometimes can be long term. So if it's a short term thing, sometimes it's part of the market sentiment. But if it's a policy that is being passed on, right? Meaning, for example, right? Give you one. Trump's tariff policy, right? It's currently still in the negotiation phase, right? So he's not set. The policy is not set in stone yet, right? So when that's happening, there's a lot of development, there's a lot of negotiation. It's very much a sentiment play, okay? Versus if today the tariff is set, okay, and you say that, all right, from now on, whatever is happening, this is going to be the tariff, right? If that's the case, that is a long-term policy, then that itself would shift the fundamental of things. Okay, so again, you want to come in from a perspective of looking at it and say, is this still in development? If it is, it's more of a sentiment play versus is this already been decided? If it is, it's going to impact the fundamentals. Alright, so you need to make that kind of like decision. Okay. So I kind of talk about a little bit of this here as well already in terms of like, understanding economic data, FOMC meeting, NFP, etc. Okay. Just a pointer. Okay. A lot of traders would look at all this data and make a fundamental decision on it, right? Or simply trade the economic data and say they are trading the fundamentals, right? You want to be very, very clear. Today, if you're trading a particular data, you are not trading the fundamentals. You're essentially just trading the short-term volatility from that data. Okay. For those of you who have been trading maybe NFP or some key economic data before, you realize that sometimes a good data prices can go down. Sometimes a bad data prices can go up, right? It's like, why is it the opposite? Okay, again, because short-term movement due to all these releases, they are all sentiment. Okay, so when you're trading the news, you're trading the data, you want to understand that you're literally trading the surprise element of this data. So if people are expecting this data, for example, people are expecting NFP data to come out at maybe 298,000, right? The actual data comes out is 250,000. Now, people will say, oh, it's a bad data, but not necessarily, right? Because if today the expectation is set very high and the actual data is here, it might just mean a sentiment disappointment, right? And therefore short-term prices will be down because people are selling. But you then, from a fundamental point of view, it's different, right? Because from a fundamental point of view, you need to assess the part where, all right, there's 258,000 new jobs created. Is that a good thing for the economy? It might be a good thing, right? So as a trader who trades news, you want to be educating your client, they are not really trading the big picture fundamental. Yes, you're trading the news, but those news are very, very short term. They are sentiment play. Okay, and when you trade the news, you don't want to hold a position too long because oftentimes you will realize if you buy, prices, yes, can go up in the short term, but oftentimes it will come back down, right? So that's that volatility in play. Just bear that in mind, okay? So let's apply a little bit of all this in the current market situation, okay? Let's talk about precious metal first, gold, right? Because a lot of traders are very interested in it. It hits all-time high this year. What's next, okay? So if you apply fundamentals and you understand that, all right, overall currencies are often going to be devalued. Okay, long-term picture, currencies are often going to devalue, right? Why is that the case? Because central banks are often printing new money. Okay, that's the cycle, right? Increasing rates, cutting rates, quantitative easing, printing money. So money supply is always increasing in the economy. And supply keeps increasing, it causes a devaluation. So if you stretch it long enough, your money value is always dropping. Okay? Now, if your currencies are always in devaluation, compare it to a precious metal which has quote unquote a finite supply. Okay, gold is not easy to produce, it's difficult to produce, you can't suddenly increase supply. So quote unquote, we have a finite supply of gold. Currencies keep increasing in supply, precious metal like gold don't increase as fast. What would happen in the long run? Prices would go up, right? In precious metal. So if you ask me 5 years down the road, 10 years down the road, where would gold prices be? I can very confidently tell you it will be higher than where it is today, 5 years down the road, 10 years down the road. Okay. So aka, what does it mean today? If you're looking at long-term investment, buying into precious metal is a very, very safe choice. Okay, doesn't mean that it's gonna go up every other day. Doesn't mean that you're gonna be buying at the lowest price right now. But it just means that if today you're looking at long-term perspective, you want to focus on the bullish buys. Okay, you want to focus on buy trade opportunity or investment buy opportunity. Okay, so that's on precious metal. Now today, if you talk about equities, it's the same thing, all right? Because you're looking at indices, companies against currency, right? So anything against currency in terms of the asset classes generally will go up, right? So that's something you can apply, right? So equities market and sentiment, I kind of talk about it in the previous slide, right? About tariff. When uncertainty kicks in, equities market tends to go down because of risk off. And then when things are calm, equities tends to go back up during a risk on environment. Okay. We also talk about safe haven, right? So safe haven currencies are your Japanese yen, USD, Swiss franc. Okay, this three. Now among these three, the Japanese yen are often the more sensitive one. Okay. What I mean by more sensitive is during a risk on, yen tends to see a little bit of weakness, quite obviously, and then during risk off, the yen would strengthen quite a bit. Okay, so it's like the most sensitive to market sentiment is Japanese yen. So far so good, everyone can follow. Yeah.